I'm going to be talking about financial literacy and gender gaps. This is joint work with Laura and Margarita. So this is, so it's not a long time ago that we finished this paper, so it's a great time to still get feedback. And actually the previous talk was great because you could see financial literacy as a control variable, and this time you're going to put it on the other side. So what is financial literacy? For those who are not that familiar with this concept, financial literacy measures the understanding of basic financial concepts. Before we could see that they were using the set of 3 questions. Another way of measuring is using these big 5 questions. Instead of 3, we have 5. And the typical way people measure financial literacy is just looking at the percent correct out of these 5. Okay, so let me show you just one of those. So this is one of the questions on compound interest rate. And one thing that I would like you to notice is that in the typical survey measuring financial literacy, there is always one answer option that includes I do not know. Okay? So if you think about it, there are 2 ways in which people can answer. People can go for the I don't know option, or people can actually try to guess the correct answer. Okay? Okay, so financial literacy has been shown to impact important decisions in people's lives, like, for example, retirement plans or saving plans or even stock market participation, as we saw previously. And therefore, many governments now have one as a priority policies to improve their population's average financial literacy. Financial literacy also is known to be distributed not equally among the population or comparing different groups. And one such group is if we divide people by gender, by their sex. So men are known to be more financially literate than women. This has been found not only in one particular country, this has been found in many different countries, and also over time has shown persistence, okay? The second thing that has been found that is not in this slide, but it's also important, is that men are also more likely to not to choose I don't know option, while women are more likely to choose I don't know option instead of the rest of the answers, okay? So in this project, we want to switch the focus to how this is measured, okay? And if you think of an ideal setting, an ideal scan machine that I would like to have, and I think most maybe central banks would like to have, is the kind of a blood test, or maybe don't think of such a big intervention, but maybe saliva test that we could actually administer to people and find out exactly how much they know, okay? Instead of asking them and responding, basically having their knowledge for those who would have chosen the I don't know option, but also for those who actually don't choose that option, okay? Now we are far away from that machine, as far as I know, and in reality what people do, what central banks do, they administer this survey, including this I don't know option. And therefore, the only thing that we can really observe is the choice of I don't know, the probability or the frequency of the choice of I don't know, and also the actual correct answers for those who didn't choose the I don't know option, okay? For those who actually adventured into trying to guess their favorite question, okay? So if we want to compare groups, for example, men and women, and if we know that men and women actually have different likelihoods of choosing I don't know, then we may have a problem, okay? So think of a very extreme example that I made up, okay? And then assume that financial knowledge, financial literacy is exactly the same and perfect for both men and women, okay? But that we also can assume that maybe all men actually go for the right answer, okay? And all women happen to choose I don't know, because they don't want to reveal it, okay? In this extreme made-up example, using the regular financial literacy measure, we would conclude that men have perfect financial literacy score, they know it all, while women had nil financial literacy, okay? Because they would all choose I don't know option, okay? So with this, I would like to motivate what we do in this paper. And what we do is a survey RCT design to see whether simple interventions can affect the choice of I don't know, okay? And do they do it differently by gender, okay? This would be our first question. And then the second question is, once you have shown that this is probably malleable and you can change people's propensity to choose I don't know, then does this have effects on the financial literacy measures and also maybe by gender? Okay, so this is what we are going to be doing in this paper. Let me tell you a little bit about the RCT design. Then I'm going to move to the results and finally try to conclude. Okay. So about the RCT design, we administered or we designed a survey for 6,000 participants. This was externally implemented by a company that is called 40DB, that is actually here settled in Madrid. This was done October, November 2022. The actual design of the survey was approved by the ethical committee back home by my university, and also the design and the pre-plan was registered at the AEA. The whole thing is done online. It takes at most 15 minutes, okay? And it includes about 40 questions in total, okay? So the only thing that we manipulated, we changed, okay, is going to be one particular part of the financial literacy section, okay? So we are gonna have in the control group, we are gonna have 2,400 participants doing the regular financial literacy Big 5 with the regular I don't know option, okay? So standard control group. And then we are gonna have 3 different treatment arms. The first treatment arm is going to be just deleting this option of I don't know, okay? The second treatment arm is going to be, we are economists, so let's provide some incentives, okay? So now we are gonna tell people, well, you can get some extra money if you get correct answers, okay? And the third treatment arm is going to be just the pure information nudge, okay? This information is gonna include the actual 2 findings that I told you about, that men are known to get more or higher score in financial literacy, and also that women are more likely to choose I don't know. Okay, so it's just simple provision of information. So the whole design is going to be a common part with no time restriction, which is going to include various variables of sociodemographics, okay? Then they're gonna move to the financial literacy section. There we are going to have a time limit, and the goal was to avoid them to be looking for the right answer outside the survey, okay? So that's why we have a time limit. And then once the financial literacy part is finished, then we are gonna have also again a no time limit section on some extra information about them. That is also common, okay? So the control group, I repeat, nothing, the typical financial literacy section. The first treatment arm is going to have this omission of the option I don't know. The second treatment arm, some extra incentives for monetary incentives for the correct answers. And the final treatment is going to be the information, okay? So let me move to the results section. In the results, I'm gonna show you first, just looking at our control group, we wanted to make sure that our people was the typical people, okay? That these 2,400 people, we could replicate the 2 main findings that were also found by other people, okay? So the first thing is, well, if we just look at the percent correct, and these are the first 2 columns that you see, we can replicate that, yes, men are more financially literate than women, okay? And indeed, there is a 9 percentage point gap, okay? Men get 58% of the questions correctly, while women get 49% of them, okay? The second thing that we can also replicate is that in our sample, women are more likely to choose I don't know option, okay? 18% of women are choosing I don't know option, while 12% of men are choosing it, okay? So again, we see a 6 percentage point gap that says that, well, women are more likely to choose I don't know, okay? So in that sense, our sample is the regular sample. There is nothing particular about these Spanish guys, okay? So let me move now to the effect of these simple interventions on the choice of I don't know, okay? So I will show you here 3 columns. In the first column, we don't include any controls. In the second column, we include all the controls. And in the third column, we just include a set of lasso selected controls, okay? The second and the third column pretty much say the same thing, okay? So let me start just mentioning the female coefficient. As I said, or I showed you before, without any controls, we see that there is an almost 6 percentage point gap on the percent of I don't know, okay? It's 18 and this 12%. And then part of this is explained by some sociodemographics, like, their interest in finance and so on and so forth, okay? But still we have a significant gender gap of 4 percentage points, and I'm reading the second column and the third column of the female coefficient. What about the interventions? Are they effective at all in changing people's choice of I don't know? And the answer is yes, clearly. This is something that we could indeed change, and it's malleable, okay? So all three interventions are indeed very effective in changing people's choice of I don't know option, okay? So something that is also showing this is that the choice of I don't know is not only measuring lack of knowledge, it's also something different that is measuring, because these interventions do not really measure or do not really impact how much they knew, okay? So by gender, we see some extra differences. I'm not gonna comment much on the without I don't know, because everything is by construction, okay? If you cannot choose that, and a priori we had women choosing more likely or more often the I don't know, this omission is coming directly. But what we can see is that the provision of incentives doesn't do anything different by gender, okay? But the provision of information indeed is even eliminating the gender gap in the choice of I don't know once we control for the sociodemographics, okay? So what we find is that this simple intervention of just providing this information nudge is able to even eliminate this gender gap in the choice of I don't know, okay? So these are the three main findings. All three interventions are quite effective in changing people's choice of I don't know. I'm not gonna comment much on the omission because this comes by construction, but the information nudge is actually very effective in even reducing, not even reducing, but eliminating the gap once we add the controls, okay? But here the question is, well, now we have this intervention that worked in terms of percent of I don't know, but did it affect at all whether they got it more correct questions or not, okay? And here, if you think about it, it's not only attracting people into answering, but it's attracting the right people into answering, okay? So how do they do it? Well, now I'm gonna show you exactly the same regression as before, but now the dependent variable is going to be just the percent correct, okay? The typical financial literacy measure. Without any controls, we have that again, we have this 9 percentage point difference, 58 and 49, okay, from the very first graph that I showed you. Once we control, part of the story is on the sociodemographics, okay, but still we have a gap of 6 percentage points to explain. And what we find is that all three interventions are effective in increasing financial literacy, but by gender, the only one that is significantly changing at the 10% significant level, okay, is again the information nudge, okay? So these are the main findings. All three interventions are very effective in increasing the percent of correct, but only the information nudge is able to reduce the gap to half. So we had a 6 percentage point, and now we have a 3 percentage point, okay? So I'm not going to repeat the results, but the main conclusion would be, well, clearly, if we want to compare financial literacy measures across different groups, we have to understand better where these differences are coming from, especially if we find such a clear difference in the propensity to choose this I don't know option. The choice of I don't know option is not only capturing lack of knowledge. If it was that, then it would be acceptable, but clearly it's doing something else. And this can be changed. This can be, so people can be moved away from this option with simple interventions. And the main conclusion would be that the typical measure comparing financial literacy between groups is overstating, in this case, the gap between men and women. So thank you very much.
Great. And now we're going to have Angelika Welte discuss the paper.
Okay. Thank you for the opportunity to discuss the paper. I'm from the Bank of Canada, so the usual disclaimer applies that this doesn't reflect the views of the Bank of Canada. Before I start, I also want to thank my colleagues from the Bank of Canada Economic Research and Analysis team in the Currency Department who helped me prepare those discussion slides by sharing their research with me. So let me just quickly outline what I'm going to go over. We'll put the paper a bit in the context of the related literature, then I'll highlight how the findings could impact equity, diversity, inclusion initiatives, and then I have a few technical suggestions at the end. So I just want to say up front that I really like the paper, that there are very important implications, and that the data set itself, I'm very envious of, is very unique and rich, and that the authors there's maybe a tendency to now that we have a paper to move on, but I think more could be done with the data. So financial literacy, I think we've heard about it, and I think we saw it also in the previous presentation, that it is correlated and could also be viewed as a tool to reduce wealth inequality and improve financial inclusion. So low financial literacy affects how economic agents make decisions, and we know that the effects are heterogeneous across groups such as people of color or women. So there's a rich literature on the relationship between financial literacy and, for example, the participation in the financial markets, and we just saw on a paper on that. So, and gender gaps on the macro level are also correlated with inequality for both the working age and the retired population. What I'm showing here is on the x-axis, the financial literacy gap, and on the y-axis, I'm showing the gap in full-time employment. So I'm considering everybody not full-time employed who is either not working or only working part-time, and then I'm also looking at the pension gap. And we see that there's a positive correlation, and then I just want to highlight that Spain, the country that we're studying in this paper, is here. So actually, in terms of the financial literacy gap, is not doing so bad, but there are some pretty big gaps. It's above the fitted line in both the labor force participation gap and the pension gap. So this is a really important question that has important macroeconomic implications, and that's why we study it. So in this paper, the authors provide a more accurate way of measuring financial literacy. So we know from various studies that women score low on these financial knowledge tests. So I'm going to call it mainly a financial knowledge test and not a financial literacy test, because I understand financial literacy to be a broader concept. I think I view it more as a skill, a functional capability to make the right decisions for your situation, but I think financial knowledge is the foundation of that. So measurements are, Nagore highlighted, they're imprecise and potentially biased due to high shares of missing data. So what they do, they actually disentangle women's lack of confidence into abilities or confidence in their abilities from the question design and the methodology. So how much is the way we're asking those questions actually inherently biased. So I think everyone who works in surveys should be very aware of that. So that the way we ask the question, the way we put it to them, can impact our measure. And it may, in this case, and that's what they're showing, this is non-ignorable. So and then they use a random control trial, which is really the gold standard to disentangle that. So I think that's a big achievement. So as I said, we have so I think this fits into the literature on financial knowledge and literacy, but also importantly in the literature on survey methodology and surveying financial capabilities. And I think the paper before that used a survey like that. So this is very important. And I think this is and I think in the next slides, I'm going to show a bit how the results from this random control trial could help us understand which interventions may work to increase financial literacy. So, I think the first line is we need a more diverse and inclusive financial literacy industry. Financial industry norms are skewed towards men. So in Canada, only 18% of financial advisors are women. And so there is actually, but I think there's some hope. So for example, we've seen that investing into like environmental conscious or governance solution is actually driven by females. So financial professionals should understand that by including women in the financial industry, that the future of their industry may depend on that. So, but at the same time, depiction of women in the financial industry continues to perpetuate those stereotypes. It's become a bit more subtle, I argue, but they're still there. So if you go here on the left-hand side, this is 1972. So apparently the wife cannot be trusted with her husband's credit card. So, great, right? So this one here was supposed to be to do what, right? Encourage women to get a financial advisor, but she's depicted as, I think I pulled this off Instagram, as airhead. And I think the ad was actually pulled in the US after that, because I think in some European countries there are now laws against advertising that perpetuates stereotypes or depicts genders in a biased or stereotypical way. And even here, it's hard to see. So this is an advertisement for ESG investing. But what do we see? Green home, woman. Green car, man, right? So I think this is a hand of a man. So great, right? So I think if we want people to encourage to be interested in financial topics, the financial industry has some work to do. And I think we've seen that nudges help. So what we also need is effective, accessible financial education. So there's a lot of work has been done. So Lusardi, who is actually the author of these big 5 financial questions, together with her co-authors, has several papers and actually a free course that you can take on financial literacy. She also conducted a study that kind of ran in parallel with the PISA study. And she looks at the gender differences. So one good news was actually that boys and girls, so at the beginning of the pipeline, they have the same average score. So I think that fits nicely with some of the papers that we saw earlier. But there's still work to do. A lot of kids have low financial literacy. And if you look at the high end, you already see the gap opening, right? So there's work to do, and I think we need to start early. And I think but they also highlight that there may be a relation with math anxiety, for example. So, and I think a really related topic is the promotion of digital financial literacy. So the United Nations has put it very succinctly: for women and girls, the digital revolution represents one of the biggest opportunities and also the biggest threats to gender equality. So while we all get very excited about innovations, we should make sure that no one is left behind, whether it's depending on their gender, their race, their socioeconomic status. I think we have a chance here to make this inclusive. Let's do it, right? So I think right now, here's some evidence of the gap. I think we in the European Union also need to be aware of that. I know there are plans to roll out a European digital identity. There may be a CBDC coming. Let's make sure that these products are inclusive, that they help the ones who need it. So one thing, and I'm just going to take 30 seconds. So there's some new research on crypto assets. So first of all, there's a paper by Weber et al., which is succinctly titled, Do you even crypto bro? Or do you even finance bro, right? So they find crypto holders are young, white, male, libertarian, right? Raise of hands, who's surprised? I'm not, right? And we also find that Bitcoin owners are actually not very financially literate, and that they also don't know that much about cryptocurrency. On the other hand, new research by Welte et al. Finds that in Canada, actually there's no financial literacy gap among crypto owners. And also there is a crypto literacy gap, but it's actually mainly explained by how long they've had the product. So I think crypto is at an all-time high. I know we have very ambivalent attitudes towards that, but I think it's something that we also need to watch. So I think there's some technical things about the model, right? I think we could if you think about I don't know as missing data, we could kind of model it as a selection. So this is more a technical comment. So that would be one way to simultaneously also capture the substitution between the responses. And I think most importantly, actually from a policy perspective, would help capture unobserved heterogeneity, because the models are very rich, but they capture less than 30% of the variation. So by controlling for selection, actually it will be very interesting to see if there's positive or negative selection once we control for everything, right? So depending on whether your propensity to choose I don't know, your latent answer, is it more likely to be correct or incorrect? So I think this is the key matter here. So it would be very interesting to do that. So gracias. I put it in Basque. I don't know if it's Kerek Asko. Merci, thanks, danke, and little pitch for our research.
Great, thanks. Okay, that leaves us with some time for questions. Sarah, would you start us?
I just wondered whether you thought, so I understand your point about the current measures incorrectly measuring financial knowledge, but do you think actually the measures that we have are actually better at capturing the sort of attribute of financial literacy and understanding that drives actual financial decisions? So, because of which, so your decisions depend both on your knowledge but also on your certainty in that knowledge. And in a sense, the measure that you have might actually be combining both of those things in a way which gets to the driver of behavior. And I don't know whether you have reflections on if you improve your measure of knowledge, you might need an additional measure to capture this certainty. And yeah, I'd be interested in your thoughts on that.
We'll take a few questions and then, did I see something over there?
Yes, thank you. Super interesting talk. And I was wondering, so from previous research, you showed that women are less likely to, or less willing to guess, right? So this goes into this direction. But that was in the context of quite high stakes settings. And here it's low stakes. Do you have any idea, because there we could think the risk aversion or things like that. Do you have any idea of why women don't want to guess and they prefer to say they don't know?
Is there someone behind there?
Hi. So I see both intervention 1 and intervention 3 as being very similar. Intervention 1, you completely remove the I don't know option. And intervention 3 dissuades people from choosing the I don't know option. So you're getting a subset of those people. I'm kind of curious because you only showed the results with the % who got it correct. But what's the % who got it wrong? Because you're basically looking at people who move away from choosing I don't know, but just the percentage of correct answers can go up if I flip a coin now, since I'm left with 2 options, right? Either a correct answer or a wrong answer. Yeah. So if you could let me know about that.
All right, Lisa, and then I think that'll be it.
So I had a related question to the one earlier about sort of why people put I don't know. I know some of the surveys that record financial literacy, so like the Survey of Consumer Finances, also ask about like self-rated confidence in financial concepts and risk aversion. And is answering I don't know correlated with some of those things, I guess, at the baseline?
Want to take a minute to
Okay,
answer?
yes.
Sorry, I can't pick more questions.
So should I do like this? Okay. So no, very, very interesting comments. Also, thank you for the discussant. Now I lost her. Okay, here. All the references. So the usual suspects for the underlying motive could be lack of differences by confidence, of course, risk preferences. Okay, so these two go in the same direction as in the typical educational setting in which there is differential reward or penalty for wrong and omitted questions. And we do see there that also women, when there is this differential grading, women are more likely to omit or just don't go for the answer. It's true that here the stakes, I would say, are very low, okay, because it's not something that many people don't even find out whether they got them correctly or not, okay? But there are other motives too. It could be that, for example, women are much more sensitive to the shame of embarrassment of getting it wrong, okay? So even though the two typical usual suspects are confidence or differences by confidence and risk aversion, we can think of also different motives. So it's not easy to disentangle about those. We do have measures of risk preferences and also confidence in terms of how many questions do you think you're going to get correctly and so on. We can compare that, and we put all those in the regressions. So part of the gender gap indeed is explained by those, but it's not removed, okay? So this would be my answer to the first and the second questions. Percent incorrect, very interesting. So indeed, to me, it's kind of amazing how the financial literacy scores ignore totally the percent incorrect, because maybe it's not only how much you know, but how much you actually get it wrong. So in that sense, we do have the outcome of percent incorrect, and if I don't remember my results in a different way, so we do see that, for example, deleting the option of I don't know, there were some differential effect by gender in terms of so we don't find strong evidence for just removing this option of I don't know, because some people actually get into answering and really don't know. So part of the I don't know option, it is measuring lack of knowledge, but not only lack of knowledge. Okay, so that would be, and I put the fourth question, correlation with preferences. But I think it's so we do include all these risk preferences, confidence measures, interest in financial topics, and they do correlate for sure with financial literacy measures. But these results that I showed you basically include are controlling for all these demographics and behavioral variables.
Thank you.
Okay, thank you.